Active fund managers like to downplay the growth and popularity of index funds. Critics of passive management have been quoted in leading financial publications as confidently predicting that indexing is destined to fade in acceptance by mainstream investors. But Craig Lazzara, managing director at S&P Dow Jones Indices, has been digging into such claims. Hi, Craig. Thanks for taking some time to talk to us today.
Thank you, Murray. It's great to be back.
Great. So what does the evidence show? Is index investing simply a passing fad?
Well, if it's a fad that's lasted more than 50 years, which I think means it can't possibly be a fad. The evidence is very strong, and it goes back literally at least 50 years. We know of some studies that are even older than that. But what the evidence shows quite clearly is that most active managers underperform most of the time. When I say underperform, I mean do not do as well as a passive benchmark that is appropriate to their investment style. So large cap US managers against the S&P 500, for example, mid cap against mid cap, growth against growth, value against value. Most active managers fail in the sense of fail to deliver excess performance most of the time. And the second conclusion that the data are quite strong on is to say that even when you find a manager who has outperformed in a particular period of time, that is not a good indication that that manager is going to outperform any future period of time. So the data are very unhelpful to active managers and help explain, of course, why passive has been as important as it has been for the last 50 years.
Yeah, I think you have estimated that there's trillions of dollars tracking just the S&P 500 index alone. And so index funds now encompass somewhere between a quarter and a third of all of the capitalization of the U.S. equity market at this point.
I mean, yeah, it's an educated guess, but it's a guess. It's really hard to get good data. I mean, we know our own indices, obviously, or we think we do anyway. So you mentioned about 7.1 trillion is explicitly tracking the S&P 500, and that's about 17% of the total value of all the stocks in the S&P 500. But of course, some stocks that are in the S&P 500 are also in our competitors' indices, in Russell 1000, CRSP, MSCI, and so forth. And so there's further indexation coming from that source as well. So when we say a quarter to a third, I think that's a reasonable estimate, but no one that I'm aware of knows for sure.
Yeah, I think also you've compared the growth in index funds to the technology boom and bust that took place in the late 1990s.
Well, here's the comparison that people often make, and I think it's the wrong comparison, but we do write about it on occasion, and it's this: investors are in some respect conditioned to believe that whenever they see large flows of money going in a particular direction, whether it's technology stocks in 1999, for example, or financials in 2006, 2007, whatever it was, we're sort of conditioned to believe that large flows of money inevitably form a bubble, and when the bubble bursts, the money flows out, and those who are participants in the bubble are always sorry. And so if that's your mindset, and I understand where that comes from, if that's your mindset, then people might just as well look at all the fund flows into passive investment management and index funds and say, well, isn't that the same thing? And in fact, it's radically different. The most important difference, I think, is that the flow of money into technology stocks in the late 1990s was an active management decision. And the people, whether they were professional investors or retail investors were deciding to make an active tilt toward the financial sector. And so lots of money flowed into financials, and it came out of other areas of the equity market. So the market, in some sense, became less diversified because people were concentrating so heavily on that one sector. And we all know how that ended unhappily. In contrast, the flow of funds into index funds is driven not by people making an active decision, but by people making a decision not to use active management. In other words, to say, I recognize that I as a retail, I'm a retail investor, I as a retail investor, that I as an institutional investor do not have the ability to decide which stocks or sectors are going to outperform in the next year or the next 5 years. And so I will simply own all of them. And recognizing, as we said earlier, recognizing that the data show that owning an index of the U.S. equity market dramatically outperforms most active managers over time. So when money flows into index funds, it is eschewing active management. And because typically it came out of individual stock positions or actively managed portfolios, the market is becoming more diversified because index funds obviously are comprehensive. And not specialized. So those are the big differences.
Yeah, I think at IFA we also take issue with this whole idea of calling something a bubble, and also is investing based on cycles. How do you know what is a bubble and what is a cycle? I mean, those seem like very artificial terms.
Well, they're obvious after the fact, but that's the problem. We all look back. Oh yeah, the technology boom in 1997, 98, 99. That was clearly a bubble because we know that because it burst. But it's the problem is not identifying them in history. The problem is identifying them as they are happening, and that's a much harder challenge for some people.
And like you said, they're caused by active managers trying to outguess the markets, not vice versa.
No, precisely, and that's the nature of active investment management. Right? Everyone who runs an active portfolio thinks he knows something that is not reflected in consensus prices, and to that degree, will try to embody his views in his portfolio, and if he's right, he does well. But as we said earlier, the evidence is quite strong that for the most part, active managers underperform.
Thank you very much for your time again, Craig.
Thank you, Murray. Always a pleasure to be with you.